Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates. We had the US retail sales and the jobless claims data yesterday from the US. JK will be, of course, taking us through that. But before he does, I just thought I'll just set the context. Now, the Fed closely watches how the economy performs, and that's a factor which will be considered while taking a decision on rates. Now, these numbers are important because retail sales tell us the strength of consumption in the economy, and the jobless claims tell us the strength of the job market. JK, good morning. A very interesting time also which is happening in the currency markets. Dollar index seems to be steady while we are seeing a sudden dollar strength compared to the emerging market segment. Take us through your thoughts.
Yeah, good morning. The global markets, of course, continued to remain on a soft patch, notwithstanding a raft of economic data, which was all mixed. Retail sales headlines surprised to the upside, but there was revision to the previous month's number also. Ex autos, it actually dropped. Fully fed manufacturing slumped by 9.9% versus 2.8 expected. And month on month, previous month it was 6.2. So the big drop in the manufacturing. Importantly, capex, new orders, and employment were all down. Only good news being the prices paid were also down. Another indication of industrial slowdown was the industrial production that announced later at minus 0.2% versus 0.1% expected, and it was at plus 0.5% last month. The only good data was the jobless claims, which further dropped to 213,000. But I don't know if it is a good news also, because it confirms tightness in labor market, no doubt. But I think participation rate is going up for employment. Rather, more people are taking up employment. There is a report which says that the personal savings of the US population has drastically come down even to below pre-COVID levels. So must be people are now looking out for jobs because EMIs have gone up, the cost of living has gone up, gasoline prices have gone up. Anyway, stocks were initially in positive territory, but steadily lost out as more and more people are convinced that 0.75 rate hike by the Fed is almost certain. And more importantly, the terminal rate is now going beyond 4.5% as per many analysts. Technical charts indicate more losses for the markets. We find it is once again on the verge of moving into bear territory, now at 80% from the peak, and Nasdaq firmly in bear territory at 70% from the peak. Yield curve is now inverted at 42 basis points. In the absence of US Fed members speaking in the blackout period, German and ECB members statements are being, on the focus. German finance minister said that inflation could lose its anchoring, and it may gallop permanently if you can't get it under control. Treasury yields surged at the front end of the curve. Obviously, the yield curve, as I said, inverted further. Markets are looking at higher terminal rate, and there was also, report from World Bank, which was more vocal about inflation remaining about 5% despite the monetary policy actions. And futures in Asian hours actually show further fall in the indices. Yeah, but as you said, I think there's a lot of action in the currency markets. If you look at the recent past, Euro broke the parity and by and large staying closer or below it. Yen broke 140 and steadily trading above it despite the noises from Japanese government and the Japanese central bank. And yesterday we had the big break in the USD yuan, rather USD CNH at 7 and traded as high as 7.03. The economy in China, as we all know, is very weak. Today's data, of course, was slightly better, but broadly, it is in a downward path. That is why the central bank is cutting rates. More so, the recent fall might have something to do with geopolitics, with Russia and China getting closer on several issues, which is not to the liking of the US. And there are indications that there may be more sanctions on China if the interests of the Western world is being worked against. So China is in not a very good spot. Chinese currency weakening beyond 7 has also influenced other Asian currencies to weaken. Several currencies are at new all-time highs, rather new all-time lows against the dollar. In Korean won alone, there has been some talk that the central bank is intervening, so that is stopping it from weakening further. In Indian rupee, of course, yesterday we had almost a complete reversal of where it moved on Monday. So we are like back to 79.80. This is more driven initially from FI buying yesterday, rather FI buying of dollars yesterday. I presume the indexes having reached near all-time highs, there must be some profit taking going on by the global investors, particularly when they are incurring losses elsewhere. Apart from that, the move in yuan beyond 7 after our OTC market closed pushed the spot USD INR to 79.89, and in fact in the offshore market it has remained high as well. For India's interest, I think Fitch also downgraded the growth forecast from 7.8% to 7%, which is notable. So rupee, once again, back to watching RBI. Or do they want to continue to defend 80 when every other currency is weakening once again? Not very sure. Looking at the global triggers and not looking to improve anytime soon, or whether they want to continue to lose more reserves defending the rupee. That's the biggest question in my mind. Thank you.
Thank you, JK. And of course, now we look forward to how the emerging market space emerges, as you mentioned. As you put it so well, that when the investors globally are facing losses, they often tend to book profits from markets such as India. And whether or not RBI is going to defend 80 is another question. Of course, we won't have any statement from Fed members now, as they are in their blackout period, and we need to keep monitoring what happens in the Russia-China relationship and how the geopolitical space pans out. That's it from us for today. We'll see you all on Monday. Have a very good weekend. Keep managing your risk. Thank you.